Hey everybody, it's John King with Summit Funding. It is Friday, the 3rd of March, and here is my weekly market update. So 4 topics I'm going to talk about today. First of all, credit report fees jumped significantly at the beginning of this year, and I never really gave you a reason why that happened or what that really means. So I'm going to talk about credit report fees and what that means to you as a consumer or you as a realtor. The second thing I want to talk about is what's going on with interest rates. Rates have definitely jumped up, and I want to give you an update on what's going on, why, and what the future's got to hold. The third thing is my masterclass that's coming up at the end, on March 23rd. I'll talk about that real quick. And then the fourth topic I'm going to talk about is why FHA is going to be a more popular loan than conventional in this year as we're looking at all the changes that have happened so far. So let's go into this year. Man, do you have any idea how much credit report fees have jumped at the beginning of 2023? It is crazy. So last year, for a single credit report, it was running around $25 for one person for me to get a mortgage credit report, which includes all 3 credit bureaus, and around $40 for a married couple. Well, guess what? On January 1st, that fee went up from $25 to $50 to $60. So more than doubled, about a $25 to $35 increase in the credit report fee for an individual person to get a mortgage credit report. And for a joint credit report, it was even worse. It was about a $40 increase to the cost of a joint credit report. Now, why is this happening? Here's the truth. The credit agencies have a monopoly. They know that they do, and therefore they're increasing their fees because we have to use them, and we don't have an option. We've shopped multiple different repositories that are kind of third parties that put together the report for us. All the fees are the same. There's nothing the industry can do about it. Now, there's 2 things the industry is starting to do. The first thing is we're starting to do more soft credit pulls. Now, what's a soft credit pull? It means it doesn't count as an inquiry on your credit report. It is significantly less expensive for us up front. Remember, every fee that a lender pays has to get built into interest rates that the consumer pays at the end. Now, credit report fees are no different, except that when you close a loan, you pay back the lender for all the credit report fees that they were charged at the beginning of the process. If you don't close a loan, the lender eats those fees. Now, does a lender really eat it? No. In no business does anybody really eat the cost of doing business. They mark up their product and services to a higher cost to make up for the lost money. And the same thing's happening in the mortgage world. It's part of why we see fees and interest rates going up on loans, because lenders are getting hammered on credit report fees. So you're going to see a lot more soft credit pulls. The problem is we still have to upgrade that to a full hard inquiry in order to move forward with the loan. And in some cases, even to get a pre-approval, we've got to do a full hard inquiry. So what's happening with some lenders is they're starting to have the conversation about charging upfront for credit reports. It's kind of funny how the industry has evolved over the years, and same with appraisal fees and credit report fees alike, that there's been eras where it's been normal for the consumer to pay for that ahead of time. Then there's been eras where it hasn't been normal. Even today, there's some mortgage banks that say, you know what, we'll charge you for the appraisal at the end, and if you don't complete the transaction, you won't pay for the appraisal at all. Guess what? That means everybody is paying for all of those appraisals that aren't getting paid for in the end. The same's happening today with credit report fees. So there's going to be a shift, and I'm already hearing the grumblings about credit reports being collected for upfront. It's going to be a change in mentality, but the truth is, if you're serious about buying a home, you're paying the credit report fee anyway. And wouldn't you rather only pay for your credit report instead of paying for your credit report at the end, as well as having your cost increased overall to pay for everybody else's credit report? Why did interest rates jump this week? It's simple. It's all about inflation and jobs and what do we think the Fed is going to do? And it's a big issue right now. We're seeing interest rates this week that are touching 7%. We haven't seen 7% since October. Now remember, early November, we saw inflation start showing that it was coming down. We saw the same thing in December and January, but in February, inflation has shown signs that it's not coming down as much. So that's a major concern. And the truth is we're going to see a lot of ebbs and flows like that. Unfortunately, there's not a lot we can do. We saw a huge shift from the high 5s to the high 6s during the month of February. We're going to have to see how March goes. We normally get the jobs report at the first Friday of the month. This month, it's going to be on the second Friday of the month, or March 10th. So next week's jobs report is going to be a big deal. And then the inflation reports that come in the second half of the month are also going to be a big deal, but I think it's going to be pretty rocky, and we're going to see movement between high fives and high sixes and tickling 7% for the next few months at the very least. The next thing I want to talk about is my masterclass that I'm doing on March 23rd. If you or someone you know are thinking about purchasing a home, you need to join me for this class because I'm going to spend 90 minutes covering everything you need to know about buying a home, and most importantly, about what's happening in this market with new loan programs, with special opportunities to save money, as well as some tips to make sure it's as smooth a process as possible. So make sure you register by going to howtobuymasterclass.com, and it is going to be at 7 p.m. Pacific time on Thursday, the 23rd of March. FHA absolutely is going to be a bigger portion of the market in 2023 than we've seen in any recent year. And there's a simple reason why. Because conventional loans are getting more sensitive to certain characteristics, and FHA loans have dropped their mortgage insurance fee. Now, let me be clear. Conventional loans are absolutely going after lower income first-time home buyers. So if you are a lower income first-time home buyer, you're going to get some advantages on conventional loans that you didn't get before. But for a lot of people that are in that middle range when it comes to credit score, it's still going to be more expensive going conventional than going FHA. And the weirdest thing is everybody thinks you have to be a first-time home buyer to go FHA. The truth is you don't. You can put 3.5% down payment on a home going FHA even if you're not a first-time home buyer. A conventional loan requires 5% down if you're not a first-time home buyer. The only time you can put less is if you are a first-time home buyer. I expect to see more and more FHA loans in the coming year, and the biggest concern is listing agents' fear of FHA loans. And that fear is simply coming from the concern of two things. One, the appraisal. Well, guess what? FHA appraisals are not that much harder than conventional. And in most cases, if a loan or home is not going to pass an FHA appraisal, it's also not going to pass a conventional appraisal. There's only a few circumstances where something is an issue for FHA and not for conventional. And my company can do a holdback. So if there's things that need to get repaired, the seller doesn't have to do it. We can set aside your money to pay a contractor to come do the work after you become the owner of the home. But the other thing that's going on is simply a matter of the listing agent being concerned that, hey, this is an FHA buyer and they're not as high quality. They don't have as good a credit as a conventional loan. They don't have as good a down payment. There's a stigma there. That stigma is real, and I'm doing my part right now to try and change that stigma. There are people with great credit that are going to be better off with FHA. There's people with good down payments that are going to be better off with FHA. So we need to start changing the narrative about FHA only being for the worst qualifying borrowers. More and more, I'm seeing that line being blurred, and I want to make sure you don't get caught in the crosshairs. Let me know if there's anything I can do to help, and have a wonderful weekend. Bye-bye.